It does not deserve the light of the day. The bill is deeply detrimental. It increases heavy taxation pressure, doubles compliance pressure, and escalates household costs. We thought it would have been expanded the economy and cushioned the ordinary mwananchi. Our first concern is the continued pursuit of unrealistic revenue targets, despite a history of persistent underperformance and an underperforming economy. The government revenue collections have consistently fallen short of targets, yet the response has been to introduce new taxes and illegal levies rather than addressing inefficiencies, broadening the tax base, or stimulating economic growth. This creates a cycle where businesses and citizens are repeatedly asked to shoulder a heavier burden to compensate for unrealistic fiscal planning. The second concern is a proposal to move certain products from zero-rated to VAT exempt status, including solar products, electric mobility equipment, locally assembled mobile phones, and animal feeds. While this may appear neutral on paper, it effectively increases costs because producers can no longer recover input VAT. The inevitable result is higher prices for consumers, farmers, and businesses. At a time when Kenya should be encouraging renewable energy, agricultural productivity, and digital inclusion, these proposals move in the opposite direction. The proposed 16% VAT on digital payment service provider commissions is another regressive measure. Kenya has become a global leader in financial inclusion because mobile money and digital payments have reduced transaction costs and expanded access to financial services. There will be more pain at M-Pesa shops and ATM machines. Taxing these services will increase costs for traders, SMEs, schools, hospitals, and ordinary citizens who rely on mobile payments. And ultimately, these costs will be passed on to the consumers and could reverse years of progress in financial inclusion. Further, the proposal to increase excise duty on mobile phones from 10% to 25% is particularly damaging to young people and low-income households. Mobile phones are no longer luxury goods. They are essential tools for education, businesses, communication, financial services, content creation for youth and the Gen Zs, and job searching. Increasing their costs will widen the digital divide and disproportionately affect students, entrepreneurs, and rural communities. We certainly know the finance bill also proposes a 30% growth withholding tax for what is called non-resident landlords, but effectively it affects the Kenyans in diaspora. While intended to raise revenue, the practical effect is likely to be higher rents for businesses and commercial tenants as landlords pass these costs to occupiers. This will increase operating costs for businesses and contribute to higher consumer prices. This is unfairly targeting our diaspora communities who should be investing back home while they work abroad. Where do you want these Kenyans to retire to? Or where do you want them to invest? Equally concerning is a proposal introducing a 60% minimum deemed dividend threshold. This measure risks penalizing businesses that retain earnings for expansion, working capital, debt repayment, and an investment. Rather than encouraging growth and job creation, firms will be forced to distribute funds that would otherwise be used for investment. From a governance perspective, one of the most troubling provisions is the proposed removal of protections against agency notices during active tax appeals. This will allow tax authorities to freeze bank accounts and enforce collection actions while disputes are still before tribunals or courts. Such powers will cripple businesses before they have an opportunity to be heard, undermining due process, investor confidence, and the constitutional principle of fair administrative action. The finance bill further proposes tax filing timelines from June 30th to April 30th and introduces stricter objection deadlines, which include weekends and public holidays, increasing compliance costs for businesses and taxpayers. These measures may appear administrative, but they are They affect businesses that lack the resources of larger corporations and will struggle to